Hi, and welcome to the Stockscores Market Minutes for April 25th, 2014. This week, I'm going to talk about the cycle that goes on in the market between the buyers being in control and the sellers being in control. We can see this on many different time frames. For the long-term investor, you will see weekly time frames where the buyers are in control and the sellers are in control. And for the more active trader, we can look to the intraday charts to see this same cycle play itself out. It is easiest to make money buying stocks when the buyers are in control, and when they are not in control, it is easiest to make money buying the inverse ETFs since it has become difficult to short stocks. Alternatively, of course, you can play the put option side in individual stocks. Now, with that short-term time frame, what's going on in the span of the next week or two, I find it helpful to monitor the 60-minute chart of the SPY using an 8-period moving average as a guide to determine who is in control. Now, here's a little chart that I've prepared of the last 15 days of the S&P 500 ETF. And you can see that when the market falls below that 8-period moving average, you get generally bearishness, a time when it is best to be playing those inverse ETFs like the SDS or even the VXX, which goes up when the market goes down. When you've got the buyers in control, which began in this case in April 14th, when you had a crossover above that moving average, now you've got optimism and follow through on individual trades. At the top of the trend, when the market runs away from the trend line, you have to be somewhat cautious. And that is why I have color coded these areas in yellow, because at the tops of these strong periods of buyer control, you'll actually see the follow through on trades start to not be so good because the buyers are getting tired, and that usually comes just before you get across under that moving average. Now, this last week we didn't have great follow through Wednesday, Thursday, Friday because the sellers were taking control, and that ultimately led to the strong selling pressure that we had on Friday. I always like to keep an eye on this chart, but you can apply this methodology with any chart. It won't always use the same moving average. You have to find the moving average that best fits the trend lines for that particular chart. And for the S&P 500 on a 60-minute interval, I find this 8-period works well. If you're looking at a weekly chart of the S&P 500, you may pick a different moving average that closely tracks that upward move in the market. All right, let's get into this week's analysis. Here's a chart of the SPY, which remains in a strong upward linear trend. I'm constantly hearing about, is this a bubble? Is the market ready to correct? Well, bubbles tend to occur when a market goes parabolic, and this market has not gone parabolic. It ran away from its trend line at the end of February. It has spent the last 6 or 7 weeks working its way back to the trend line. It is now there, and therefore we're either going to break the upward trend or continue along in that upward trend line. Since the market never really went parabolic into this little bit of quiet phase that we've been through for the last 6 weeks, I doubt that we're going to see a break of the upward trend line. Instead, I expect that we'll bounce off of that trend line and continue higher. Now, anytime you're at the trend line, you have to be a little bit cautious, but there just aren't the signs in the market that people are afraid of where stocks are going. Here's a chart of the TSX. It is doing better than the S&P 500 over the last few weeks because of its heavy commodity weighting. Energy sector is very strong, and even money is starting to come back to the mining sector, and that is helping the performance of the TSX, which has lagged for some time. And I expect that this market will continue to be a leader in the months ahead. The TSX Venture pulled back and is now starting to get some bids again after 4 or 5 weeks of, I would say, disappointing performance. That's encouraging if you like to trade the Canadian speculative stocks, where a lot of the fun action can come when that sector is hot. So it does look like the turnaround in the TSX Venture is continuing, albeit slowly. The 20-year Treasury bond is something of a safe haven. It really makes no sense that bond prices are going up and therefore yields are going down, but it's happening because there is some concern about some of the high-flying stocks in the U.S. market. I expect that once this Treasury bond market gets up to its downward trend line, which I've highlighted in red, we're going to see reality set in, and the fact that the Fed is not providing as much stimulus to the market, that should cause the treasuries to roll over and give some support back to the stock market as it continues its long-term upward trend. US dollar continues to be weak. It is in a downward trend. It doesn't have significant support until the green line there, which isn't a tremendous amount of downside, but I do expect that the US dollar will continue to move lower. The gold trade is one that's slowly developing. I mean, really heavily oversold last summer, is working its way back to its downward trend line, but has not yet broken that downward trend line. What's of key importance on this chart is whether the market can build from its rising bottom. So right now it is creating that rising bottom. You can see the lows of the last 4 or 5 weeks are higher than the lows in December. If it can then break the downward trend line from a rising bottom, that's a pretty strong sign that there is a turnaround underway in gold. For now, it is only a glimmer of hope. As it stands today, the trend in gold remains low and down, and until we get that break of the downward trend line, we have to err on the side of caution with gold. Oil market came up to its line of resistance, as I said. In the last couple of weeks, I felt like the energy sector was a little bit overextended to the upside, and the weakness that we had in oil prices last week contributed to some selling pressure in the energy sector. I took profit on many of my energy trades with the expectation that probably be able to buy those things back cheaper, and as the long-term upward trend continues, take advantage of selling on the highs and buying back on some weakness as the trend up continues. The VXX is a good example of why I'm not too concerned about the stock market as it tests its upward trend line, because there's really no significant spike up in fear. Yes, money has moved to the safety of the treasury bonds in the US, but it's not taking insurance in the option market, and that tells me that investors may be a little bit cautious, maybe want to take some profit on some of their winners, but they're not running for the exit door away from stocks. So my outlook then on US stocks, long-term bullish but short-term bearish. I do think we could see more of a pullback, particularly if tensions in the Ukraine continue to escalate. Canadian stocks bullish in the long term and neutral in the short term. Just as the US market is falling back, you could see a bit of a stall in the Canadian market. Gold neutral on both accounts. It's really a bearish trend, but it is trying to break that trend. It is trying to build a rising bottom, so there is some hope there in gold. Oil neutral, it's been in a sideways trading range for a long time, and now that it's hit the upper part of that range, we should see a little bit of short-term profit taking in the energy sector. US stocks are fighting with long-term resistance, making short-term pullback likely. Canadian markets are stronger on an improving commodity market. Gold still has potential to break its long-term downward trend line, but there is work to be done. Expect a short-term pullback in oil and energy stocks. Have a great week in the market and trade well.